The BDC sector has been through a bit of a rough couple months. It's underperformed the broader high yield space. Sectors like utilities, REITs, and even just dividend growth stocks, as you look at a fund like SCHD, they've meaningfully outperformed the BDC space. And it's not hard to figure out why. The BDC space had been leading these sectors really since the beginning of 2022 when the Fed started to hike rates. Inflation was rearing its ugly head. Interest rates are rising. And that's simply because BDCs, they invest in loans that are primarily floating rate and indexed to short-term interest rates. So when the Fed hikes rates, their net investment income spreads increase, their interest income rises, and so therefore BDCs' earnings rise, which means their stock price is likely going to go up, their dividends are going to increase, and everything is great. And in contrast, REITs and utilities and many other high-yield stocks, they generate more stable, long-dated cash flows that are more bond proxy-like in nature. And so when interest rates rise, inflation rates rise, the next net present value of that relatively fixed cash flow stream declines, and so their share prices decrease. And so that's where BDCs were the better play when the Fed was hiking rates, but now the market sentiment really in the last several months has shifted. And in fact, in September, the Fed actually made this a reality, pivoted towards rate cuts. And so BDC income is now expected to decline, making them relatively less attractive plays, while these REITs and utilities and other dividend stocks, their net present value of their relatively stable cash flows is becoming more attractive, and so their stock prices are rising. Another factor to consider here is the fact that the economy is increasingly becoming concerned, especially in recent months. It was due to some data that indicated unemployment was rising, consumer sentiment was declining, corporate and consumer debt were high. So people were concerned about economic downturn, and that's typically bad news for BDCs because even though they invest higher up in the capital stack, typically in senior secured loans, which does provide some protection, the businesses they invest in often are more susceptible to economic downturns. They're middle market businesses that are in special lending situations that they can't just go to a typical bank or the bond market. They have to go to a specialized lender like these BDCs to raise capital. And so they're going to be a little bit more sensitive to economic downturns. And so between the 1-2 punch of lower net investment income as well as higher non-accruals, that's going to hurt BDCs a bit incrementally, at least potentially severely, depending on the BDC and the exact economic details of the situation. Meanwhile, REITs and utilities tend to be more recession resistant, especially triple net lease REITs, because again, very conservatively structured leases, mission critical assets for the companies that rent these properties from them. They tend to be maybe more defensive industries. Utilities are regulated. They provide essential electricity, water, you name it, gas, etc., to their clients. And so again, they're much more resistant in the face of a recession. So for those reasons, there was that sector shift. However, some recent news kind of flipped the narrative a little bit and has now boosted BDCs a bit while REITs and utilities are facing a little bit of a correction. Before I get into that though, and also share some of my top BDC picks at the moment, if you could please give this video a like, it greatly help its distribution. Thank you very much. Okay, so what is this good news? What are the things that have happened to kind of change the narrative a little bit? Well, first of all, jobs came in and they were better than expected. Also, hourly wages increased, and that was really the big key to me because it increased on an annualized rate of 5%, which is well above the Fed's target rate of inflation of about 2%. And so that's an inflationary wage gain. And so that means that one, the economy is probably stronger than, or at least not as bad off as some may have feared, at least in the near term. And the inflation forces are still blowing, the inflation winds are still blowing. And so that is that double hit, the Fed's dual mandate of maximizing employment while minimizing inflation. That's a double hit to their incentive to cut rates aggressively, say in November. Now, they may end up cutting rates here soon, but we don't know. But it's less of an incentive to do it. So the odds of at least aggressive cuts are reduced some. Additionally, concerns about, again, an economic downturn with rising non-accruals for BDCs also weaken some. So that boosts BDCs. Meanwhile, reducing some of the tailwinds that were blowing for REITs and utilities, and you've seen that reflected. Many of the REITs and utilities have pulled back a little bit in recent weeks. So for those reasons, things are actually looking up a little bit for BDCs. In fact, Goldman Sachs reduced its odds of a recession in the near term to only about 15% for the U.S. economy. So again, a boosted outlook for the BDC sector. With that in view, how am I approaching the BDC sector? Well, I've long been saying I've been underweight BDCs. I was underweight before they went through the recent underperformance period. I was loading up on REITs and infrastructure and utility stocks, so I benefited from that. But I'm not completely abandoning the BDC space. And in fact, recently I've re-entered it to some degree. I went down to really just 1 or 2 core positions and undervalued quality BDCs that I liked for diversification purposes. And now as the tide seems to be shifting, that the valuations have corrected a little bit, I've added another BDC to my holdings at High Yield Investor. But here are 3 that I think are worth considering. Again, there are several that I really like right now, but these are 3 that I think I don't own all of them, but I do think I wouldn't mind owning them. I rate them all at least buys, if not strong buys. So the first one, which is one of my core BDCs, it's one I never sold, is FSKKR. And I like FSKKR because it's not that sensitive to interest rate cuts by the Fed. It only has about a 7.5% NII hit expected per 100 basis points of Fed rate cuts. Now, so far they've cut by 50 basis points, but at every 50 basis point cut, you're going to see maybe a 3.75% decrease to net investment income, all else being equal. That's not terrible. That's very manageable at them. Their base dividend is well covered by earnings, by their net investment income. Yeah, sure, their special dividends may go away or decline, but that's okay because the base dividend still has a really high yield, and they trade at a very large mid-teens discount to their net asset value, despite having an investment-grade balance sheet being managed by KKR, which, by the way, they've had some non-accrual issues and some underwriting issues, but the vast majority of those were due to loans that were underwritten by their previous sponsor. KKR has had a much, much better track record as far as that goes with FSK, and now they occupy over 90% of FSK's portfolio. So I expect their underwriting performance only improve moving forward. That should, again, reduce their discount to NAV even more. So I like FSK. They also have actually significant exposure to defensively positioned investments, whether it be senior secured loans or asset-based lending, both of which are quite defensive and should hold up fairly well in a recession. Another BDC I really like right now is Gola BDC. They have one of the lowest fee structures of any externally managed BDC in the publicly traded BDC space. And so that stands for a lot. As Buffett has said, performance comes, performance goes, fees last forever. And so when you have a low fee structure, that takes some of the burden off management to squeeze out excessive outperformance in order to justify the fees and still deliver a satisfactory risk-adjusted return to shareholders. So I like that a lot about GBDC. They also cover their dividend by over 20%. Yes, they're a bit more sensitive to Fed rate cuts, but they have a strong balance sheet. They have a strong dividend coverage ratio. Their yield is well over, it's like 11%. They have a lot going for them. They have a large exposure to senior secured loans. Well over 90% of their portfolio is invested in those. So, there's a lot to like about GBDC. They could even potentially get an upgrade in their credit rating from Moody's, which would give them the highest credit rating of any publicly traded BDC from Moody's if that were to happen. So, that also speaks very highly of them. A third one that I like, I don't currently own at the moment, but I have owned in the past, made good money off of it, and I like it. It's a little bit riskier, but it has a lot of good metrics going forward, is CION Investment Corporation. They trade at a very large discount to net asset value. They offer a very attractive dividend yield that is well covered by their net investment income. They're buying back a considerable amount of stock. That's actually quite rare for a BDC to do that. They have a solid balance sheet, a leverage ratio that's really not unreasonable at all. They had surprisingly strong underwriting performance. Their non-accrual rates is quite low. And, their interest rate sensitivity is also quite low, actually, to Federal Reserve rate cuts. So for all those reasons, I really like them. Just some cautions, though. They have a much smaller team. They have really outsourced, actually, a lot of their work. And so they don't quite have the workout capabilities that some of their bigger peers like FSK or even GBDC or certainly Aris Capital Corporation or Main Street Capital or Blackstone Secured Lending, some of these bigger, more prestigious names. So if we were to go into a really distressed environment, they might suffer more than others in terms of coming out the other side in good shape. They also have a higher percentage of their income coming from PIK loans or payment in kind. Now, they say they specially structure a lot of these, which is probably true. But again, that just has increased risks to it. And so for that reason, I'm not a big fan of a CION just in this current environment. But again, I think if you're going to have a broadly diversified portfolio of BDCs, I think CION is a worthwhile holding. And so, hopefully, these picks are helpful to you. They give you an idea of how to approach things. Again, I just want to keep in mind that I don't think it's time to go all in on BDCs. I'm still underweight the sector, relatively speaking. And I don't plan on significantly upsizing my exposure unless valuations come down significantly from here. But I do think that it's worth maintaining a diversified portfolio because, as these latest jobs numbers, especially the wage numbers, made clear, we don't know exactly what's going to happen in the future, and we don't know what the Fed's going to do. And so I think it's good as a high-yield investor to have that balanced portfolio where you have some BDC exposure, some REIT exposure, some utility and infrastructure exposure, some midstream exposure, and some exposure to other stocks and sectors out there as well. Because again, that enables you to always have capital in hand, opportunistically capital recycle. You're not overly committing to a macro call. You can still focus on fundamentals without worrying about being overly concentrated in any single sector. So again, hopefully this video was helpful for you. If it was, please give it a thumbs up. Please subscribe to my channel to get future content like this. And again, let me know in the comment section below what you think about BDCs right now, what you think about the recent economic news, and what BDCs you like the most. Thank you very much. See you next time.